Bitcoin's latest move says a lot about the market we're in right now. On Wednesday, prices pushed above $72,000, briefly touching $72,865, as global risk assets rallied on news of a fragile Middle East ceasefire. That momentum didn't last long. Within hours, selling pressure dragged Bitcoin back toward the $70,000 range before stabilizing. Still, the nearly 5% move wiped out over $477 million in short positions across the crypto market, showing just how aggressively traders were positioned the wrong way. More importantly, this wasn't just a crypto move. It mirrored equities, reinforcing the idea that Bitcoin is still tightly linked to macro conditions, especially during periods of geopolitical tension. Under the surface, the structure of this market is becoming clearer. Institutional flows, particularly through ETFs, are acting as a stabilizing force, absorbing supply and preventing deeper pullbacks. But at the same time, on-chain demand remains weak, with older holders distributing and retail participation still relatively muted. That's why, despite strong support around $68,000 and upside projections as high as $80,000, the market continues to trade in a choppy range. It's stable, but not yet explosive, and that's where the next shift comes in. Today's video connects a lot of dots, from Iran to China to Bhutan, and shows you how fast the global financial system is starting to move toward crypto. If that sounds good, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for tuning in, and let's dive right in. Let's begin with this tweet of Real Vision's CEO, Raoul Pal. According to Raoul Pal, this kind of short-lived rally might actually be the early signal of something much bigger. In a tweet posted Wednesday, he wrote, "Total global liquidity is rising. Global M2 is rising, US. Total liquidity is rising, US M2 is rising. China's total liquidity is rising, ISM is rising. Try not to overthink it." This ties directly into Pal's long-standing everything code thesis, the idea that global liquidity drives all major asset prices, especially crypto. And if he's right, then what we're seeing now isn't just a reaction to geopolitical headlines. It's the early stages of liquidity returning to the system. In simple terms, more money flowing through the global economy means more capital searching for returns. And historically, that's when Bitcoin and crypto markets move the hardest. Now layer that on top of what's happening on the institutional side. Morgan Stanley has officially launched its own Bitcoin exchange-traded product, the Morgan Stanley Bitcoin Trust, MSBT, marking a major step in integrating crypto into traditional finance. This isn't just another ETF. It comes in with a highly competitive 0.14% fee, undercutting rivals like BlackRock's IBIT, and signals an intensifying battle for institutional capital. Even more important is the infrastructure behind it. Custody handled by Coinbase and administration through BNY Mellon, showing that crypto adoption is no longer experimental, it's operational at the highest levels of finance. What this creates is a powerful combination, stabilizing institutional demand on one side and improving global liquidity on the other. And historically, when those two forces align, markets don't just grind higher, they accelerate. Now here's where things take a dramatic turn, and where crypto quietly shifts from a speculative asset into something far more strategic. According to recent reports, Iran's Islamic Revolutionary Guard Corps has effectively turned the Strait of Hormuz, the single most important oil choke point on Earth, into a pay-to-pass system, charging up to $2 million per tanker for safe transit. But the real story isn't the fee, it's how they're demanding to be paid. Not in US dollars, but in Chinese yuan and dollar-pegged stablecoins like USDT and USDC. In other words, one of the most critical arteries of global energy trade is now, at least partially, operating outside the dollar system. This is real-world, high-stakes usage of crypto in global trade, under geopolitical pressure, at massive scale. And it goes even further. Iran has already moved to formalize this system into law, explicitly structuring it to bypass U.S. sanctions and the traditional financial rails. Reports indicate that vessels must negotiate directly, receive encrypted clearance, and complete payments before being escorted through the strait, essentially creating a parallel financial system where crypto is required. When you combine that with estimates suggesting this system could generate tens of billions annually, you start to see the magnitude of what's happening. This is no longer about retail speculation or even institutional exposure. This is crypto being used as a tool of statecraft, embedded directly into the flow of global commodities. And this is exactly the kind of shift analysts have been warning about. According to market commentary from Bull Theory, what we're witnessing is part of a much larger structural transition away from the dollar-dominated system. Global institutions and governments are increasingly borrowing in Chinese yuan instead of dollars, driven by significantly lower interest rates and deeper trade ties with China. At the same time, the US dollar's share of global reserves continues to decline, while China expands its influence across global trade settlement. But the key detail, the one most people are missing, is that Bitcoin and crypto are starting to appear on the edges of this transition. Because when a system begins to fragment, when countries actively look for alternatives to the dollar, you don't just get one replacement, you get multiple parallel systems. The yuan rises as a trade currency, gold regains relevance as a neutral reserve, and crypto, especially Bitcoin and stablecoins, emerges as a censorship-resistant bridge between them. What's happening in the Strait of Hormuz is a real-time example of that shift. Payments are being made outside traditional banking channels, across borders, under geopolitical tension, and crypto is facilitating it. And if that trend continues, then the implications are massive, because it suggests that the next phase of crypto adoption won't be driven by hype cycles or retail speculation, but by necessity. And if all of this still feels early, the data suggests we're not just early, we're massively underestimating the scale of what's coming. According to recent research from Chainalysis, stablecoins are already processing $28 trillion in real economic volume as of 2025, growing at an explosive pace of 133% per year since 2023. And if that trajectory continues, we're not talking about incremental growth. We're talking about a complete overhaul of the global financial system. At the current rate alone, stablecoin volume could reach $719 trillion annually by 2035. But with two major structural forces accelerating adoption, that number could climb as high as $1.5 quadrillion. The first driver is something most people aren't connecting to crypto at all: the largest wealth transfer in human history. Between 2028 and 2048, an estimated $100 trillion will pass from baby boomers to millennials and Gen Z. And unlike previous generations, nearly half of these younger cohorts already use or have used crypto as a default financial tool. That means as wealth changes hands, a significant portion doesn't flow back into traditional banks. It moves on-chain. Chainalysis estimates this shift alone could add over $500 trillion in annual stablecoin volume within the next decade. The second driver is even more immediate: real-world usability. Right now, paying with crypto still feels like a choice. It requires extra steps. But as stablecoin payment rails become embedded directly into merchant systems, that friction disappears. At that point, using stablecoins becomes indistinguishable from tapping a card, and when that happens, adoption doesn't grow linearly, it accelerates. This transition alone could add another $200+ trillion in annual volume, pushing stablecoins into direct competition with the largest payment networks on Earth. To put that into perspective, Visa processes about $13 trillion annually, while MasterCard handles roughly $9 trillion. Combined, that's $22 trillion per year, a number that once defined the scale of global commerce. but stablecoins are already approaching that level on a monthly basis, with recent figures hitting $7.2 trillion in monthly volume, surpassing traditional systems like ACH and rivaling card networks far sooner than expected. So when you zoom out, the narrative becomes clear. Crypto isn't just competing with the existing system, it's quietly rebuilding it from the ground up. Faster rails, borderless transactions, programmable money, all converging within a 10-year window. Now, in the short term, that doesn't mean the market moves in a straight line. Recent on-chain data shows that the Bhutanese government has moved 319.7 Bitcoin from a state-linked wallet, with part of those funds reportedly heading toward wallets associated with exchanges. Bhutan has become known for mining Bitcoin using its hydroelectric resources and periodically selling into the market, so naturally, this kind of movement raises concerns about potential sell pressure. And yes, if those coins do hit the market, it could introduce short-term volatility, but zoom out again, and the scale tells a different story. Even a few hundred Bitcoin entering circulation is relatively small compared to the trillions in liquidity, institutional flows, and global adoption trends we've just outlined. Events like this may shake the market temporarily, but they don't change the underlying direction. Because right now, three major forces are converging at once: rising global liquidity, accelerating institutional adoption, and real-world crypto usage at the geopolitical level. And when those forces align, markets don't just recover, they expand into entirely new territory. So the real question isn't whether crypto will grow. It's whether most people will recognize what's happening before it's already priced in. If you found this breakdown valuable, make sure to like the video, subscribe for more high-level analysis like this, and let me know in the comments, are we still early or is the next phase already underway? Thanks for watching and see you in our next video.